Global Times, 8th of November 2022, China raised 8 times as much money in Europe than in the US from January to October, when US markets turned against them. So far, in 2022, Chinese companies have raised more money in Europe than in the US. From January to October, European funds were about 8 times greater than funds from the US. But the real question is why China needs to borrow money from other countries and have trouble paying it back. 7 Chinese companies went public on the Zurich and London stock markets in the first 10 months of the year, raising more than $2.5 billion. More are said to be on their way. During the same period, Chinese businesses in the US raised only $303 million in funds, a 97.67% drop year-over-year. Rules were put in place to make sure that the right books of records were shown. China has a lot of dishonest brands. Dealogic, a global source of financial data, says that this year was the first time that Europe passed the US as the first place where Chinese companies went public. China has to borrow money from other countries because Chinese people are too smart to invest in Chinese businesses. 30 A-share businesses have said they will issue Global Depository Receipts, GDRs, as of Wednesday. 24, or 77%, chose to list on the Swiss stock market. The other 3 decided to be listed on the London stock market. Statistics from the local financial data provider iFind showed that 4 companies did not say where they were going. 7 companies have been recorded successfully, and 24 more are still being processed. Analysts said this was likely to happen because the US had been pushing for financial decoupling from China. It made sense, then, that Chinese companies would choose Europe as their first choice for an IPO. The CSRC, which oversees securities, said at the beginning of September that it would improve the GDR business under the Stock Connect scheme and urge more Chinese companies to issue GDRs. GDRs are certificates that can be bought and sold that are given to represent shares in a foreign company. They are traded on a local stock exchange. In the Global Times, he talked to Dong Dengxin, director of the Finance and Securities Institute at Wuhan University of Science and Technology. He said that GDRs are cheaper than IPOs, and getting approved in overseas markets is easier because the issuer is already listed on the A-share market. The Shanghai Stock Exchange, SSE, said in a statement that on July 28, the first group of companies listed in Shanghai was able to successfully list on the SIX Swiss exchange, which is Switzerland's leading stock exchange, through GDRs under the China-Switzerland Stock Connect scheme. These companies raised a total of $1.6 billion in capital. Notably, the SSE said that the rules for GDRs had been changed so Chinese companies could list GDRs in Switzerland. The changes went into effect on July 25. The exchange said that the China-Switzerland stock will join the 2 markets make it easier for people to share market resources, and help companies in the SSE market become more global. The CSRC changed the rules for the Stock Connect program between Chinese and foreign stock markets in February. This made it possible for Shenzhen, Switzerland, and Germany stock exchanges to join. So they can get money from people who don't know about Chinese scam businesses. Before, companies listed on the Shanghai and London stock exchanges could only use the plan.